Hey everyone, welcome back to the channel. If you've been with me for a while now, you'll know that I recently invested a large portion of my portfolio into Pershing Square Holdings, which is the fund owned by Bill Ackman. I'm actually going to do a breakdown of the fund with fellow YouTuber Karan Gurnani. He is a stock investor, a value investor at heart, and he actually has nearly 1,000 people following him on eToro. That's not available in the US for stocks specifically, but he's from the UAE, so he is able to actually take advantage of that, and he is essentially a fund manager himself. He also has a YouTube channel with about 2,000 subscribers as of the filming of this video, so definitely check out that channel as well. It's in the description below. He puts out a lot of great content, mainly around value investing. But without further ado, let's get into it. Hey Karan, thanks for joining me, and big congrats on your recent success on YouTube. You're really ranking up pretty quickly there on the subscriber count, so congrats there. I wanted to talk to you about Pershing Square Holdings, since I know it's a major holding in your own portfolio, and we wanted to have this conversation. We were talking about it a while back about the spawner framework that Mohnish Pabrai has, and kind of apply it to Pershing Square Holdings, since it seems like there's a pretty good fit there. So before we get into that, you want to explain what the spawner framework actually is?
Hi, Jack. Well, thanks for having me on the channel. So the spawner framework, it's a talk that Mohnish Pabrai recently gave to Peking University, where he talks about focusing on companies that are growing. Basically, they're spawning out new businesses, right? So he mentions there are companies that produce adjacent spawns, non-adjacent spawns, embryonic, and clonal spawns. And he gave an idea about what companies that he sees in the market that are spawners. So in my view, Pershing Square Holdings is actually a fantastic spawner. They've got plenty of short, intermediate, and long-term catalysts.
Let's get into those catalysts that they might have. I guess it makes the most sense to kind of go over, well, I guess first let's explain what Pershing Square is. It's the fund owned by Bill Ackman. That's Pershing Square is his company, his hedge fund. And they definitely made headlines this year, or back in 2020, when he went on CNBC, and you probably all saw the hell is coming quote. That's him. That's his fund, and it did really well in 2020, despite what the media might have spun. And it does have some promising holdings, so I think it makes sense to go over those holdings. They are in order of actual holding size. They're pretty close to the same size. But we have Lowe's, Chipotle, Restaurant Brands, Hilton Worldwide, Agilent, StarBucks, and Howard Hughes. And Lowe's is the biggest holding at about, I believe it's 19% of the fund. And it's anywhere from 19 to 10% of the fund is all those holdings. So that's kind of what we're working with Pershing Square.
Plus, we've got the CDS hedge.
Yeah, those aren't the only holdings. Those are the major public holdings. And they also have their hedges, which through credit default swaps. And then they also have a large interest, or a large sort of future interest, in Pershing Square Tontine Holdings, their SPAC, which we can definitely get into.
They even have Fannie Mae and Freddie Mac too also. Those two are they're kind of co-positions, although smaller allocations, but they could have a huge upside, depending on how the ruling goes in court, yeah.
Right, and that ruling is about privatizing those institutions again, essentially, which they're subject to a lot of regulation. Fannie Mae and Freddie Mac, they're the ones who buy a lot of the mortgages in the US, so it's very heavily regulated, especially since 2008. So there's a lot of uncertainty there, and certainly a lot of opportunity as well. Why don't we go through any of those holdings? Maybe we could start with Pershing Square Tontine Holdings. How would that be a spawner under the Pabrai framework?
So with regards to Pershing Square Tontine Holdings and the next SPAC that he has announced. So that's exactly what it is in terms of being a great capital allocator. He's taking on debt at like around 3%. I think he's taken on 1 billion recently. Yeah. So he's taken on some debt, and he's just putting that into SPACs because interest rates are quite low. So he's taking advantage of that, finding better opportunities where he's able to get a higher return.
And because of his skills as a capital allocator, at least his perceived skills, Pershing Square Tontine Holdings is trading at a premium to its actual cash value. So that could be a sign of things to come for Pershing Square Holdings, the sort of top-level fund, which actually trades at a discount to its net asset value, which is an interesting point that you've definitely pointed out a lot in your channel. It's something like a 30% discount, or maybe more at this point, to those underlying holdings that it has. Here, let me check it now. They post it every single week, Pershing Square Holdings. So right now, it looks like the net asset value to share is $49, and it's currently trading for about $36 a share. So you got about a $13 premium there, which is about, 36% discount to NAV at the moment. Yeah, so it's trading at a significant discount, which is a little weird because Pershing Square Tontine Holdings doesn't trade at a discount. It's trading at a premium. So you'd expect to see some sort of convergence there in the future, at least one would hope.
So the NAV will definitely increase. So when the deal is announced, there's going to be additional $2 billion that's going to go into Pershing Square Tontine Holdings. And that's going to go into the IPO price of $20 per share. So suppose it goes to $40 per share. The value that they get from that is around $4 billion. So immediately there's an increase of $4 billion, which is crazy because the total fund is at around $7 to $8 billion right now.
That's referring to those warrants that Pershing Square Holdings has in Pershing Square Tontine Holdings. So the better Tontine Holdings does the SPAC, the better that Pershing Square Holdings will definitely do, since they get an immediate discount from the warrants they have on it. It's a little bit of a complicated structure to understand at first, but that's definitely a source of spawning for sure for Pershing Square Holdings in the very near future, one would think, as long as they find a decent deal.
I think they will. I think he's already got a target in mind.
That would make sense given that he's trying to open up another SPAC. So we'll see what happens there. It's hard to say exactly what'll happen. The SPAC space is so seemingly random at times, and you want to make sure you're not overpaying for a business as well, which Ackman's generally very careful with. What about some of the risks that Pershing Square Holdings is facing? Before we kind of go over some of these underlying holdings, what risks do you see with the fund?
Well, I don't see much of a downside risk. His strategy is very defensive. So in down markets, it tends to fall less than the rest of the market. But suppose we go on a huge, from somewhere we go on even a bigger bull run, right? The fund will tend to underperform. I think that's the largest risk, but I really don't see that happening because I feel like we're at peak right now. It feels like a peak, it feels like we're really like reaching all-time highs, even though the market's dropped recently. But
that seems to make sense, that opportunity cost would really be the biggest risk here because they have a large hedge with their credit default swap position we mentioned earlier. And if the market were to go up, those credit default swaps would probably be worth a lot less and could eventually be worth less completely. And that's about 1% of the total fund right now, which is a significant amount if it were to go bust, but certainly not catastrophic.
But he said he hopes it expires worthless.
Right. Market crashes are generally pretty brutal for just about everyone, and it'd be best if that never has to trigger, but they have that downside protection nonetheless. So what about the actual underlying companies? I looked at the PE ratios, so price to earnings ratios, and then the return on invested capital percentages, just to get a rough estimate as to kind of what these businesses are trading for based on their earnings, and then also how well they are at allocating capital to potentially produce that spawning sort of phenomena where they can grow on their own. So just going down the list again, Lowe's right now trading at about a 25% price to earnings ratio, so a little on the high side, but they have a 20% return on invested capital, so very high. So the money that they are reinvesting into their business is being compounded at 20% per year currently. That's not necessarily perpetual, but certainly off to a good start.
With Lowe's, Ackman's actually mentioned that he sees it more as a bond. That's what he sees, rather than owning bonds. He would rather have Lowe's, at least the dividend from them is stable. It's a continuous source of cash. And I think that's how he views that particular holding. I think he would probably sell out of it if better opportunities come.
Which is an interesting thing for him to say, given its return on invested capital. It seems like it could keep growing, but you could see it as sort of a bond with more upside. Of course, there's downside as well to any investment, but that's an interesting perspective on a company that seems to be primed for very solid growth. So that'll be an interesting thing to see what he does there if it gets to some price target that he has in mind.
I feel like Lowe's is going to get stronger as a business. Like we've seen a good increase in the amount in their earnings and stuff. So I think it could do really well, especially, as people start receiving their payments. People are going to want to invest in their house and so on and so forth. I think it's going to be a huge tailwind for Lowe's as a business.
And we definitely saw that at the beginning of the pandemic with the first round of stimulus in the U.S. Lots of home improvement projects. People started lots of investment back into people's homes, which Lowe's and its competitor Home Depot and others definitely benefited a ton from. I guess moving down the list onto Chipotle, they are trading at a much higher price to earnings ratio of $113 or 113 price to earnings ratio right now. But they also have a pretty high return on invested capital and have for quite a while at around 16%. Obviously, these numbers fluctuate with however the business is performing year to year. But looking at around a 16% return on invested capital, so also very solid.
So he was actually, I think, involved in the company when the whole scandal had happened. He's been involved with it ever since the business has kind of got to turn around and really take off.
They actually did reduce their holdings in Chipotle pretty recently, back in January, I believe. So they reduced their stake in Chipotle by about 6%.
I think they're just making cash. They're taking profits just to have more cash to invest that money into the SPAC. So the $2 billion that they need extra, I think that's the whole plan. I think so. I have no idea. This is just me speculating, but
that makes sense. Because it's certainly been quite a compounder over the last few years, and maybe he's just taking some risk off the table there to go for other opportunities. So that makes sense. I guess moving down the list again, Restaurant Brands, currently at an 18 PE, and about an 8% return on invested capital, and it's been pretty stable there for the last couple of years. I forget when they actually opened their position in Restaurant Brands, but I think it was a few years ago.
He's the reason that Restaurant Brands actually came together. Yeah. There was Burger King with 3G Capital, and he kind of merged it and then got it to the public markets. And they merged with, I think, Tim Hortons and Popeyes, I think. I'm not sure. But it's Burger King, Tim Hortons. And
didn't they do that? They did the Tim Hortons spin-off, right? And that's what produced quite a bit of value in itself.
Yeah.
That's sort of an example of a spawner type deal in that,
yep.
Or maybe a late stage spawner in that you have a business to spin off that has its own value that you can use to then go for other opportunities. That's kind of this idea of a spawner framework, in that you can develop multiple business lines or business opportunities, and they can each grow independently or with each other. And Restaurant Brands is just another example of that. Lots of different brands in Restaurant Brands. It's a broader portfolio of multiple restaurant brands. It's in the name, after all.
And he's been the person who kind of made it happen. So it's a testament to him being a great capital allocator also.
And to that, one of his big things that he talks about a lot is his ability to connect companies with really strong leadership. He's been deemed a sort of activist investor, and what that really means is typically when Pershing Square buys part of a company, they'll buy enough to where they can influence the board, or will do something to change management and turn the company around that way. So they're not necessarily going to take the Buffett style approach, very passive, let management do what it does. Generally speaking, they take a much more active role more often than not, where they'll try to actually influence a large change in the company. With Restaurant Brands, it was that Tim Hortons spinoff. That was something that the board was not doing, that he was able to sort of negotiate. With other companies, he's able to install new leadership, and that can help facilitate a turnaround. So if you want to look at that as a sort of source of spawning, it's his ability to put in great leaders in the companies as well, because he's so well connected at this point and has a reputation too.
It's funny you mentioned Buffett, actually, because Bill Ackman has said that in the past. So when Buffett was running his partnership, Buffett would actually be more involved as an activist. So when he was managing a lot less money, which is what Bill Ackman's at right now. I mean, no doubt, 12 billion is a huge amount of money, but it's still not that much compared to what Buffett's at, like just 150 billion in cash. But in terms of being an activist, Buffett was quite, into influencing management. That's kind of what happened with Solomon, and even with Seas, like he was very involved.
And Kraft Heinz, if I'm not mistaken, he's on the board of Kraft Heinz, or was at least. So yeah, it's not that he does not take an active role, but yeah, I think you're right that Bill Ackman's sort of at the earlier stage of what Buffett was. Not saying he will become the next Warren Buffett, but he's certainly on the trajectory if he keeps it up. So we'll see what happens there. It's hard to keep up that pace for so many decades, like Warren Buffett did and Charlie Munger and others for so long. It's more the length of time that they kept up their amazing performance that's impressive, less so than just having a couple good years. It's a few good decades back to back to back.
They've been creative in the way that they use the float from the insurance business. So I draw a parallel to how Ackman is using SPACs. So he's like getting large pools of capital that he's able to reinvest. And that's exactly what Buffett is doing with the insurance business. There's a parallel over there.
That's a really good observation. I wouldn't have thought of it that way, but yeah, they both have sort of this constant source of liquidity, just obviously manufactured in different ways, but that's an interesting observation that I wouldn't have thought of. So it'll be funny to see where Ackman ends up.
That's the spawning.
Yeah, you're right.
Yeah.
That the source of the spawn is always some sort of cash, or I guess debt, if you want to go a little more leveraged, but some sort of liquidity is what you need to do any of these things. So both certainly have had that. Moving on to the next company in the list, we have Hilton Hotels, which certainly has not done good in this past year. Pretty much the entire hotel industry has been really struggling. So there's a lot of uncertainty there, which could lead to a lot of opportunities. Hilton has a negative PE. I don't even know how negative it is, but certainly not good. They have a negative return on invested capital, but before the pandemic, they were around 7% or so. So if we got closer to normal times, you'd probably see something like that, but who knows what the new normal will be with travel in the next few years. But obviously there's opportunity there. So wondering what your thoughts are on it.
With Hilton, it's different because they franchise out their name. So the Hilton name, so they don't directly have to, they basically collect the royalty on top. So the way the business is structured is actually fantastic. That's probably what has gotten Ackman so interested in Hilton specifically, as opposed to Marriott or, any of the other opportunities.
Yeah, because it takes a lot of risk off the table in that you're not actually owning the hotels or with other franchise models, the restaurant or whatever it is. It's a different source of risk. Obviously, you got a lot of marketing expenses you have to do to get that, and some of the sort of centralized administrative stuff, that's going to be expensive. But yeah, you're right. The really significant cost of actually running the hotel, very different. And that's something that they're not necessarily exposed to. But they're still exposed to the hotel market in general, and it's got to do well in order to collect these franchise fees. And I know he doubled down on it after the crash, and he used, I believe, a lot of the credit default swap funds that he had earned to buy more Hilton, with the sort of idea that independent hotels and independent mom and pop sort of hotels were probably not going to make it through the pandemic, and that would mean someone else would come out on top. So these larger brands, we'll get to Starbucks in a second, same sort of thinking he had there, that it's really going to be the dominant brands that are going to be the ones that make it out of this really rough time, especially in the hotel space. And since I mentioned it, let's just talk about Starbucks as well, which has certainly done better through the pandemic, even though its business has certainly hurt. Its price to earnings ratio has shot up to 191. So unusual given they took a hit to earnings this year, as many businesses did, but they're at about a 10% return on invested capital, so also pretty solid. And sort of with the same framework with Hilton, Starbucks is going to be a dominant coffee brand or dominant cafe brand, whatever you want to call it, whereas the sort of mom and pop coffee shops, cafes, they're going to struggle if they make it through the pandemic at all, which means on the other side of the pandemic, which is what we're counting on, Starbucks should maintain its leadership and solidify it in the space. That's his thinking there. I want to know your thoughts on that as well.
So Starbucks, I think, was the company that he invested the highest amount of proceeds from his credit default swap investment. He put in around 600 million right at March in the lows. So it's done pretty well for him. And also Starbucks in itself is a spawner. So they started, of course, with beans initially, like way back in Seattle. And since then, the business has gone from strength to strength. And then when the CEO came back, Howard Schultz, when he came back, like the company again, like they kind of worked around their business model and focused on their core competency. They are expanding, of course, into new markets within China. And not only that, but they are pivoting their business in a very different way. So they've got Starbucks Reserve, which is their specialty coffee version. So as opposed to just takeaway coffee, you can come in, look at, the bean options and everything. So it's a lot more customized, right? If you're willing to pay, like, how much is a cup of coffee in Starbucks in the US? I have no idea.
Oh, I never go, but I think it's about $5 for a normal cup. But if we're talking about Reserve, there's one that opened in Chicago, my hometown, where the line was out the door for this experience when it first opened. And that was even during the pretty rough times we had in the summer. So that is a good point. I didn't think of Starbucks Reserve as a sort of not a spin-off, but a spawner. Yeah.
Even now they've gotten into alcohol. So there's plans that Starbucks in the daytime they'll have coffee and then at night they'll have alcohol, right? So that's a completely different sort of business model. It appeals to a whole different crowd. It's a way of spawning. If it works, it's going to really take off and form an entire new business line for the company, like a new revenue source.
Moving on to the next one, we have Agilent Technologies, which has a 47 PE and then a 15% return on invested capital. So certainly doing pretty well, relatively speaking, and has potentially a larger runway for growth with that nice return on invested capital metric, if they can keep that up.
I have no idea. I haven't really looked into the business, to be honest.
Well, that makes two of us then, because I'm not too familiar with the businesses either. Here, I'm pulling it up right now. The general description is that they're an analytical instrumentation development and manufacturing company, and they're headquartered in Santa Clara, and it says that they were established as a spin-off from HP.
That's the thing with spawning, with spawners like Pershing Square. You may not understand everything that the person who's allocating the capital may be investing into. Howard Hughes, for example, like they're a huge shareholder in Howard Hughes. But I completely don't understand Howard Hughes. I get it, it's a master plan community. But beyond that, I don't have like a huge understanding, and he's really investing in it. Same with Agilent. I really don't know the business. It's way out of my circle of competence. So you kind of trust the person who's allocating capital here. We're betting on Bill Ackman being able to deliver on the returns. That's
going to be true with any fund. It does depend on the actual fund manager and to a large extent. So you are trusting him there, obviously. And even with good positions that you like, you never know when he'll sell out of it. And you might be like, hey, I don't want you to sell out of it. So it kind of depends there too. That last one you mentioned, Howard Hughes, they're mainly a real estate developer. So that's their bread and butter. But real estate development across the board has done pretty rough for a lot of sectors, especially in the U.S. So currently at a negative PE and a negative return on invested capital. And that one definitely has some uncertainty in the future, but he is investing pretty heavily in it, or did through the last year.
They have a joint venture with Heritage, by the way. Howard Hughes.
Oh, that's right. I forgot about that. It is a joint venture with Heritage. Heritage Growth Properties is the sort of, I don't want to say the darling, but one of the very popular sort of value investor stocks. We saw Mohnish Pabrai, Warren Buffett owns the debt. We saw Phil Town on a smaller scale. So got a lot of different value investors that got involved in Heritage and are still involved. We'll see what happens there, and maybe that's a sign of good things for Howard Hughes as well.
But with respect to Pershing, so there's also some downsides. So Ackman is someone who invests with a lot of conviction, right? And with Howard Hughes, for example, I don't know how the investment is going to pan out. Like, I hope it does well. But in the past, he was also heavily betting against Herbalife. And he's like, I'm going to bet against it till the end of the earth or something, some quote like that. He invests with a lot of conviction, but that is not always a positive thing. But I'm okay with that, because again, you trust the conviction of the person that you're investing with. Even with the SPAC, so it's the largest SPAC ever created, right? Now that may not necessarily be a good thing, because with SPACs, the smaller they are, the easier they are to merge with a potential target, right? If it's a small SPAC, you can get in at a lower market cap, merge with a company, bring it public. But for a large SPAC, you need a large company, and many large companies would maybe not want to be listed on the public markets. So I feel like it's in fact more difficult.
And I think that's the sort of bane of all value investors, at least as they've said it too. It tends to be a lot easier to find quote unquote good deals at a smaller scale, whereas as you scale up, those deals become less frequent, and then of those companies that are in the buyer pool, or in your potential pool of things that you will buy, are much larger and typically have maybe a lot more buyers and sellers and a lot more volume that will not necessarily swing the price as much.
I think what's really changed, what personally got me invested in Pershing Square now, apart from the discount NAV and everything, was that he's actually made mistakes and he's learned from the mistakes. Like, at least that's what he portrays whenever he's doing an interview. Like, he mentioned that, he's made the commandments and he's put them on each person's desk.
He actually has a lot of good interviews out there. I think he's a little underrated in that space. Whereas everyone's going to listen to Buffett, which, you should. He has a lot of good stuff to say too. But Ackman has a lot of good ones too, from a lot more recently too. He recently had his failed venture in JCPenney, for example, tried to turn that company around. He's been very candid about what he's learned from that and how to actually change a company, especially one that is as large as JCPenney was. That's an example of one that he's been candid about.
I like that he's made mistakes and he's okay with it.
Right.
Yeah.
And it's not that he's moved on, but he's learned from it. Same goes for Herbalife. They're not huge on shorting direct companies anymore. It's a different business, and there's a lot of risk asymmetry there too, since there's no limit to the top to it, and there is a limit to how much you can actually win on a short.
But he's still shorting. I mean, with the CDS, it's a short position, but he's doing it in a better way.
Right. That's why I was saying, like, he's not picking individual companies. It's not that he won't short anything, because if there's a chance to hedge your portfolio at a good price there too, which he thinks the credit default swaps are at a good price, then now your portfolio is hedged on the downside. And even if it might take away some potential upside, not having downside is not so much of a bad thing either, depending on your risk tolerance. Any final thoughts you have on Pershing Square Holdings or this spawner framework from you, Karan?
Sure, yeah. The final thoughts is, please do not take this as investment advice to anyone watching. That's the main point. We are just two people on YouTube discussing an investment that we like. And that's pretty much it.
As for me, I like the stock.
Yeah, that's definitely right on. We are not financial advisors. However, you can copy Karan on eToro if you're outside of the US. He is a successful eToro investor, and you're actually able to copy portfolios out there on eToro outside of the US. So if you happen to be an international investor, Karan's a good resource potentially for some investment ideas, but not advice, of course. Well, anyways, thanks, Karan. I appreciate you coming onto the channel, and we'll have to do something over on your channel at some time in the future.
Sounds good. Thank you for having me.
That's pretty much all I've got for today. Like I said at the beginning of the video, definitely check out Karan's YouTube channel. I'll go ahead and link it below in the description, so be sure to check that out and support his channel. And if you're not already subscribed to my channel, be sure to do that by smashing the subscribe button below, in addition to that like button, since both would help out the channel a lot. I put out new videos every single week, as they have to do with investing and personal finance. And be sure to check out the affiliate links in the description below. There's some free stuff down there. Might as well take advantage of it while it's there, since that would not only help out the channel a lot, but you can get some free stuff while you're at it. But until next time, take care.